Hey everybody, it's Jared with Exponential Wealth. I just wanted to come out with a quick video on what's going on in the stock market today. These are crazy times, but it's gonna no PowerPoint, just gonna go off a whim. So what's going on right now in the market is basically what you call a short squeeze, and what's going on in the market right now though is not just your normal vanilla short squeeze. It's like short squeeze on steroids pretty much, but without going into the whole detail on how it's such a bigger issue than just your normal short squeeze. I'm just going to go over just the basics just so you guys can get an understanding. So without further ado, I'm just going to go over how a trade is started, right? So a trade is started, you have a start and you have an end, right? To a trade. Now, question is, how do you start a trade? Right? You start a trade by opening a position, and then you end a trade by closing a position. Right? So you have an open and a close. So keep this in mind because this is very important right here. And make that a little smaller. Yeah, so keep this in mind because this is very important. Okay. So now, for most of us, when you buy a stock, you make money. So here, sorry, I'm just gonna see how I can explain this. So if you go long on a stock, or you're bullish, this is all just trading terms, regular investing terms. So it's nice to get very acquainted with these type of terminology, just so you can understand what people are talking about. So if you're long a stock, if you're bullish a stock, you want the stock to go up, pretty much, right? If you're short a stock or you're bearish, right, you want the stock to go down. Long, bullish, you make money when the stock goes up. Short, bearish. My bad. Bearish, you make money when the stock goes down. So with your normal long bullish, you make money when the stock goes up. So what you're going to do, you're going to start your trade, right? You're going to buy to open, right? This is because you're buying the stock and you're opening the position. So you're buying to open. Now, how do I end this trade if I want to sell? Let's say I'm retiring and I want to liquidate my retirement account. So I'm going to sell all of my stocks, right? So what you're going to do, you're going to sell to close, right? So this is basically like the cycle, the full circle. So you start your long position by buying to open, and you end your long position by selling to close. Okay, this is what most people do, and this is the simple, sweet way of making money. But on the other opposite end, there is a way to make money going down, right? And that's what you call shorting, or I'm gonna put bearish just so you know the terminology. And you make money when the stock goes down. So taking what we learned up here, how to start and end a trade. So when you're shorting, you are going to start your trade by selling to open, right? So you're opening a trade, but you're selling. You're selling to start your trade. And then when you want to end your trade or close your trade, you are going to buy to close, right? And this is where it kind of gets confusing because people don't really understand this concept. But when you're short selling, right? When you're short selling and you're opening your short position, when you sell, people are going to ask, well, how do you sell a stock that you don't own or currently have? Right? I didn't buy it, so how do I sell it? So this is where the brokerage is going to basically lend you someone else's shares. Right? They're going to lend you someone else's shares. This is like when you go to the bank and you deposit $1 if you come back a week later and say, I want my dollar back, you're not going to get your same dollar bill, the exact one that you put into the bank. You're probably going to end up getting someone else's dollar bill, right? So in essence, this is what short selling is, and this is, not the easiest concept to understand, but this is the basic of short selling. So now another term is going to be called short float. So now short float is a very important term because this basically identifies the percentage. This is the percentage of the shares that are sold short relative, and this is relative to the total amount of shares that are sold in the market in general, right? So if there is 1 million Tesla shares, right, that are out there in the market that are able to be traded, if 10% of the shares, if the short float is 10%, right? So what does that mean? That means that out of the million shares of Tesla that's out there, only 100,000 of those shares are sold short. Right, so the short sellers are basically shorting 100K shares right here, and that's 10%. So this short float percentage is very important. Now, when this short float percentage, sorry, I don't know what I'm doing here. So when this percentage gets too high, right? When it gets too high, that means that these short sellers are in danger of what you call a short squeeze. Now I'm going to bring up a chart of Tesla because this is a perfect example of what you see in a short squeeze. And this also contributed to the reason why Tesla has gone up way higher than a lot of people have expected. So right here, I drew my resistance level, right? I want to say around $500, right? So as you can see, Tesla right here at this point, make it easier for you to see. Tesla at this point came down, right? And this is because all the short sellers shorted Tesla down here, right? And it came down, so they made money. There's a lot of people who were short on Tesla and still are short on Tesla, but more back then than there is now. These people want Tesla to go down, so they're going to short up here. They're probably going to short up here. They're probably going to short up here because they're making money as the stock goes down, right? They're adding to their position. Let's pretend you didn't know this was going to happen. They probably shorted up here. They shorted up here. But this is where they kind of got screwed over because the bulls, the people who were long Tesla, they either were holding their shares, so that means that not many people are willing to sell their shares at this price, and you have bulls that are buying, allowing the stock to have such high buying pressure that it shoots the stock up. So what happens when you shoot the stock up? Now all of these shorts, they're trapped and they need to cut their position because they're losing money. So when you're shorting a stock, you lose money when the stock goes up. All right, so this is also, or I'm gonna put it down so you can see it visually. If Tesla is at $500, right, and you buy Tesla, let's say I buy one share, what's the most I can lose? The most I can lose is $500, because if Tesla hits $0, I lost 500 pretty much, right? If Tesla is at $0, Tesla cannot go to -1, right? -2, -$500. That's impossible. 0 is the lowest that a stock can go. So I put in 500 for this share. Tesla goes to 0 because, I don't know, let's say Elon takes the company to the ground for some reason, but they're worth 0. I lost $500. But when you short sell a stock, right, and Tesla is at $500 and you short sell one share, right? You short sell one share. Now what happens? If Tesla goes up to $600, you're down $100 now, right? And theoretically, if Tesla goes up to $1,000, how much are you down now? You're down 500. So this is an issue when you're shorting and the stock goes up. You are basically going to have to be forced to either add more money into your account. And this is because the brokerage lent you their shares, right? So they're taking a risk. What if you go to the bank and the bank was like, oh, sorry, we can't give you your money. We actually lent it to someone so they could buy a house. That's not right, and that's not going to happen, right? So that is a risk that they're taking. And when you are in a short position and you are losing money in a short trade, then the brokerage is going to ask you to add more money, which is what you call a margin call. Right, this is basically their margin call. It's like, hey, your short position's down. You're going to have to add more money so we can reduce our risk. That, or they're going to force to close the position, right? So take this percentage right here, and I'm going to show you what happened with Gamestop. Gamestop right here, if I can bring your attention down to the bottom, GameStop is at 121.98% short. 129% short, right? That means that the brokerages, they lent out more shares than they even own. Or more shares than is even out there in existence to be able to be traded. Right? This is right. So this is what you call over leveraged, right? This is what you call over leveraged, and this is the reason why the institutions are losing a whole bunch of money. And pretty much, as GameStop goes up, the institutions are losing money on their short positions. Right here, they probably shorted. It got pushed up. They got squeezed out, so now they have to buy to open, applying buying pressure. Buy, and so much buying. And I'll show you here in extended hours. This is where extended hours is where the institutions trade. So as you can see here, boom, they're covering their position, right? They're covering their position. This is why GameStop was going up way higher than it needed to. Question is, can it go higher? Because there's still 100. GameStop was actually at 100 and I think 150. I think so, yeah. It was at 150. Now it's still at 121. That means there's not enough shares to go around to be able for them to be able to cover their position. Remember what I said, when you cover your position, you have to buy to close, right? You have to buy to close. And when you buy to close, who are you going to buy it from, right? Who are you going to buy it from? There has to be a seller that's willing to sell you their shares at the price. If not, the seller's going to be like, nah, it's not GameStop. It's not high enough. They don't want to sell it. They don't want to sell GameStop at 500. Right? So these hedge funds that are in the short position, they're panicking. They're like, there's no sellers at 500. Now, this is what happens in supply and demand. GameStop, you know, it goes from 500 to, I'm going to just, for example, say, and I actually hope it does, but let's say it goes up to 1,000. Now, let's say here at 1,000, you have your seller. Now they're like, okay, that's fair. Now I'm going to sell it to you. Right? So pretty much the people who are holding GameStop are in control now. They get to control how high they want GameStop to go, because if they're willing to hold until a certain price, that is when these funds will be able to cover their positions. They are cornered, they are trapped, and they are over leveraged. And this is a once in a lifetime probably opportunity to experience. And I'm sure after this, the SEC, the people who regulate the stock market, are not going to allow this percentage to get over 100%, because now they're getting screwed over. And the people who are exploiting this is WallStreetBets, right? Reddit, the community, Elon Musk, you know, who else? I forgot who else, but there's a lot of people that are on board. Oh, the twins from Facebook. Oh, the Winklevoss twins. I don't know how to spell their names, but everybody, they're on board because they want to see the hedge funds that over leveraged, who got greedy, right? The greedy hedge funds. They want to see them suffer, because we are playing the same game that they do to us, the small guys. And once we play their game, that's when they start getting angry. That's when they are saying, hey, this is fraud. This is manipulating the stock market. This is what they've been doing every day. So this is why it's important, and this is what a short squeeze is. And I'll probably make more videos in the future on the details of what's called a gamma squeeze. And for this very reason, you're going to need to know options, and we will probably come out with an options video before that. So thank you for watching, and I hope you